Hey, good morning, everyone. Marty Mazzari here. It's Thursday, the 13th of March, 2025, Thursday, with your end of week snapshot. Don't think I need to take a huge amount of time today. There remains, and I'm sure it's no mystery or no secret to any of you watchers and listeners, that there is a mound or a plethora or a lot of uncertainty circulating throughout markets and creating an unusual amount of volatility, let's say. A lot of the volatility seems to coincide with headlines coming out of Washington. Today is no exception. As I speak, the Dow is down 340 points, the S&P is down 85 basis points, and the NASDAQ is down 125 basis points, or 1.25%. So another notable decline, at least at this moment. It's 11:45 Eastern Time, 8:45 Pacific Time. But now the volatility index is now solidly in the green. It was notably in the red even when the market was falling. So the market's getting nervous. People are buying protection, pushing up the price of implied volatility in options and so on. So what's that all about? Well, presumably the catalyst would be the president's message that he wants to throw 200% tariffs on spirits coming from Europe because they tariff U.S. whiskey to the tune of 50%. And so European stocks are taking a pretty good hit this morning. Our Eurozone ETF is down, not as much as the U.S. It's down a little more than 0.5%. That's been a no small reason, European stocks, as to why our core is holding up nicely, our core allocation so far this year. But I told you here a week or two ago that we're not taking that for granted, and we took an opportunity to buy some cheap insurance to keep anything devastating in the near term happening to those positions, if indeed we get aggressive tariff action, trade war action with the Eurozone, which I expect is coming. But as I've also reported, there is a big move to do things vastly differently than they have historically in Europe from a fiscal standpoint. Germany is running into some political headwinds. They're the big dog there who can actually make a big difference from a government spending standpoint. So there's nothing completely certain about that yet, but the incentive and the desire is there. And I think if only incrementally we are going to see more action from a fiscal perspective in Europe that makes to us those relatively cheap equities look pretty attractive longer term. So again, there's just a litany of things that we can talk about, most of them not so good concerning the market. Where we're beginning to see that finally reflected is in high yield spreads. This chart on your screen there is the 10-year spread, this 10-year junk bonds or a 10-year junk bond index versus the 10-year treasury. This is the yield difference, and you can see it's at 3.2%. So you're going to make a 3.2% annual yield owning the bonds in this junk bond index versus owning treasuries. So the difference, that would be the premium you get. Now that is actually historically low. So I've heard commentators say that, spreads are not telling us that there's any big risk in the economy and therefore no big risk in the markets, right? And that makes some sense, and that's part of our own financial conditions index, and it still scores pretty tame. And so the logic behind that is that when the economy is weak and companies that are in that low grade or low rated state because of their balance sheets, therefore they call them junk bonds, their default levels or the number of companies that default goes up drastically, of course, in a recession when people aren't spending and their revenue stops coming in. So when the market starts bidding up or bidding down the price of those junk bonds and up the yield, that is a concern. Now, that's where I want to get to. That's the operative word, beginning. So I don't think it's safe to say that the spread is still at 3%, therefore everything's fine. No, it's actually when the spread begins to widen is when you need to take notice. So here's the S&P 500, right? So right in here, you can say that, spreads were still historically low, and then the market promptly took a 27% dip, peak to trough, as they were rising right here. yield spreads began to rise rapidly. As they began, the market rolled over to the tune of 35 to 40%, which depending on which index you're looking at. And you can see this throughout history. This is a 30-year chart that, for the most part, when we need to start thinking about it is when the direction changes. And you can see this is a dramatic rate of change. So this is a big red flag right here for the market for sure. The other thing I wanted to just touch base on is the NFIB small business survey that just came out. You can see that it's still elevated relative to where it's been since COVID, right? But it did take quite the leg lower, and this is just overall optimism. Hiring plans rolled back over, and that's a bearish trend there. And CapEx, expansion plans, really rolled over hard this last month. And I want to pull up this this note from Bloomberg this morning and kind of speak to that, because the other thing that concerns me, let me go back here, is the prices index. So in the NFIB survey, I believe pretty much across the board companies say that they are going to be raising prices on their customers here in the coming weeks. So here's that Bloomberg article. You can see that just overall optimism rolling over here, but the uncertainty index, right, is really beginning to rise again. More businesses indicated a pause in investment, right, or capital investment, as they assess the administration's policies. The share of firms that raised prices increased the most since April of 2021. The largest share in nearly a year said they are planning to boost prices in the coming months. All the while, economic data is not doing so hot, right? Our index actually is now a -9. It's still not dramatically big, red flag recession, but it does say that recession risk is rising as we speak. So that's a concern. If you're having rising prices amid a slowing economy, the term for that is stagflation, and that's just a really, really bad thing overall. So, lots to watch, lots to be concerned about. Of course, a change in strategy relative to trade could turn these markets around in a hurry, because indeed that is what's troubling them now. But that comes from a backdrop that has been very technically suspect, as I've been showing you for months, and an equity market that is just historically overpriced. So I would argue that what we're seeing right now was inevitable, but there's always some perceived catalyst. An obvious one right now would be the concerns over trade. Okay, so without any further rambling there, take a look at the screen in front of you. This is the S&P 500 index, 1-year daily chart, and you can see we have blown through that 200-day moving average right now with force, with momentum. That's today's candle right here. The blue candles are the down candles. So we did, 4 days or so of battling with it, and I said that could go for weeks, if not months, and here we are breaking through it. So what typically would be expected would be a rebound and a retest, and I could show you this for 100 years on the chart. And so if indeed we are beginning something meaningful in a correction or bear market sense, then I fully expect the market to come back, test that 200-day moving average, and we'll be watching closely. If it goes barreling through there, then we're going to be talking about, the 50-day, or which is the green line, even all-time highs. If it loses that quickly, then you could see a new round of selling, a new wave of selling, and then we're talking about much lower levels on the S&P. The rolling over of the 50-day moving average is a really bad technical sign, right? As long as you're sloping higher, that's better. But when you actually roll over, and you can see it threatened that here, but it didn't, rolling over, and then if it ultimately breaks the 200-day moving average, they have a really ugly term for that. That tends to be a real bad technical signal. So you can see where it lost the 50-day moving average here, went back, retested it before it failed. I said there's just a big air pocket right in there, and sure enough, that's what we've seen. Again, doesn't mean that the end of this bull market is near. The technicals, though, are concerning. And remember, on the weekly chart up here, I showed you a bearish engulfing candle on the weekly, and I said this is what we should expect, and I showed you the high probability of that, and that's exactly what's played out. In terms of the momentum indicators, we are oversold here on the RSI, and let me just run that back here a little bit, because I'm sure I can give you some examples. So this by itself would suggest we should expect a bounce, right? You can see it was oversold here, bounced, became oversold again, And we had a bullish divergence right here on the MACD and on the RSI, and a lower low there. And right there, we were talking about this is probably going to see a nice bounce to the upside. That's not the signal that this is giving us at this point. This is just your first oversold period and a bounce off of here. You see where I circled all these, and bounces happen pretty regularly. But while a correction is ongoing or a bear market is starting, those bounces get faded, and people sell into those bounces and take another opportunity to exit the market. You can see that this is the first real break we've had in quite some time of the 200-day moving average. For the NASDAQ 100 index, basically the same thing, right? With force, breaking through the 20, rolling over the 20-day moving average, which I respect a lot here for the QQQ or the NASDAQ 100 ETF. Breaking down below the 50 is not a good sign. That's showing accelerating downside momentum. They're both pointing lower. That 200-day rolls over, and that's a very bearish technical signal. But we are oversold right here, so don't be surprised if we get a bounce. I think it's going to take some sort of placating news, out of Washington to get that. But technically, it would make a lot of sense to me. The dollar has been tanking. Now the dollar is oversold as well, and you can see where it was oversold here before it bounced pretty nicely. We could see a pretty good bounce in the dollar, but right now the fear clearly, in my view, is recession risk. While we would suggest that the dollar goes up because folks panic and buy treasuries, well, there's been a massive rotation out of U.S. equities into other places, Europe in particular. I've talked about that a lot over the years. Everybody gets fixated on interest rates and differentials and how that impacts the dollar. History gives us multiple examples of when a rotation out of certain assets into assets in other countries also does a number on the dollar, and that, I believe, firmly is what we've been seeing here, and that could go on given the mismatch in valuations between here and much of the rest of the world. So, but again, nothing goes in a straight line. So, bounce here on the dollar, I would be cautious as to whether that ultimately would be good for equities, though, because it would probably coincide with a bounce in yields like we're seeing right here. So this contradicts what we're seeing in the data. It contradicts recession fears, because typically if you're fearing recession, well, then yields should be going lower, not higher, right? And this is where we're kind of between a rock and a hard place. I think the bond market is thinking about, the effect of tariffs and what that's going to do on inflation as long as we're not in recession, so to speak. Well, typically, bond yields drop as people buy bonds. And what do those dropping bond yields do? They make for lower mortgage rates, for example, lower lending rates in the real economy. And so, the economy left to its own devices can do some really good things. It begins to slow, yields begin to drop in response to that, and suddenly money's cheaper, and that begins to mitigate the harm of the recession, or ultimately begins to set the stage for the rebound. Here we have a situation where the economy, by many indications, and people will argue with me on that, but our observation, our own index, again, is in the negative again, says the economy is weakening. And we can see that in the cyclical sectors, in terms of the action. Staples have dramatically outperformed consumer discretionaries this year. That's another signal. And here yields are going up for other reasons. You don't want yields going up when the economy is rolling over. So again, folks, all I'm saying is just, weird times. Things can flip on a dime, but we have to keep our eye on long-term, structural dynamics in the economy and accept short-term volatility and protect along the way. Gold, as I've been pointing to, technically gold looks like a mess to me, right? Here we have new all-time high, right? And just momentum that is absolutely not supporting that, right? So gold is something we're exceedingly bullish on long-term for all the right reasons, we think. But we're concerned that, we could see quite the give back, but we're not getting it yet. Why? Because of all that uncertainty. Folks and central banks and global investors are buying gold as kind of a hedge against all this world uncertainty. If we suddenly get certainty, you could see gold, give back some. That right there we expect. That would not quell our enthusiasm longer term, but we are hedging it now for a few months just in case. So yeah, so folks, I could ramble on, lots of things on my mind. I'll shoot you something over the weekend if I feel compelled or I think there's something that would interest you or that you need to know. I hope you have the best of weekends, and I'll talk to you again soon. Bye-bye.